How's everyone doing today? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So today I wanted to talk to everybody about shareholder activism. What can banks, particularly bank boards in particular, what can they do when they have to deal with an activist shareholder? What does that look like? And maybe what are some of the potential things they could do to deal with this issue? And are we seeing this now? Are we seeing a little bit more flare up in shareholder activism? So with that being said, I wanted to bring in this article from Bank Director, where it's basically, this article is titled "Shareholder Activism Could Heat Up. Should Boards Fight Back?" A very good question. Banks could face pressure from investor groups to shape up profits or sell. Directors can take protective measures. Now, why did this topic come up in particular? Well, we just had this major bank M&A between Fifth Third Bank and Comerica, which was like a $10.9 billion deal, a major deal. And I'm going to show you in a second through this article and another article from S&P Global how that activist investor kind of played a role in forcing that merger to happen. And now that the bank M&A environment is beginning to pick up a little bit, are we going to see more activist investors basically chime in to say, hey, we're now back into a good M&A market. Your bank is not really, performing, and we really think that you probably need to sell. So with that being said, let's dive into this article here a little bit. So an activist shareholder campaign at Dallas-based Comerica highlights a pressing matter that bank boards are to be alert of. So the $78 billion Comerica is facing pressure to sell from Holdco Asset Management, which owns about 1.8% of voting shares in the company, according to a July presentation from the asset manager. Holdco argued that Comerica should seek a sale due to its perceived long-term underperformance of the stock, along with the bank's performance compared to peer institutions. Holdco added that it held stock in several regional banks it identified as underperformers with strong deposit bases. At a September investor conference, Comerica CEO and Chairman Curtis Farmer addressed shareholder pressure to sell. "My management team and the board, we fully understand our fiduciary responsibility," he said. "How do we enhance shareholder value? How do we execute against the strategic priorities that we have set forth that we believe are the right things for our company and drive value longer term?" Comerica did not respond to Bank Director's request for comment on this, but activism isn't just an issue at Comerica. Banks could face greater pressure from activists to sell now that the M&A environment has turned more favorable. Boards will need to examine their strategic plans for vulnerabilities, understand what to expect from activists, and consider other defensive measures. Now, before we continue, I just wanted to jump in here for a second. So this was an article from S&P Global Market Intelligence, and I just wanted to point out this one part. So Comerica faced pressure to sell in recent months after a July earnings conference call in which executives were questioned about the company's performance and right to remain independent, a very key term there. Following the call, activist investor Holdco Asset Management called for Comerica to explore a sale, listing Fifth Third as a potential partner. Comerica Chairman, President, and CEO Curtis Farmer said the bank was going to execute on the plan we've got at an industry conference in September. Behind the scenes, Comerica began conversations with its board about finding a strategic partner long before the second quarter earnings call, Farmer said during the deal. Yes, because it usually takes about 6 months for these things to begin to start to come together. So now let's go back here. So over the last couple of years, there have been more activity and activist investors engaging with banks than we've seen in probably a good 10 years, said David Hooper, a partner who co-chairs the Securities and Capital Markets Group at Barnes & Thornburg. He believes there's been a rise in investor activism that is connected to the industry's profitability struggles in recent years due to the rapid rise in interest rates between March of 2022 and July of 2023. Activism in banking is a function of pricing generally, explains Peter Weinstock, a partner at Hunton Andrews Kurth. As of September 23rd, the KBW NASDAQ Bank Index was up 20% year to date, outperforming the S&P 500, but bank stocks generally underperformed in 2023 and early 2024. Activists tend to buy in when bank stock pricing is depressed and then tend to be more aggressive when M&A pricing is higher. So activist shareholders can fly below the board's radar for years, gradually accumulating shares until they have enough of an ownership stake to force a change. Motives can vary widely. Some may want the company to sell outright, while others want to see an improvement to profitability. Some may seek a board seat to have a say in decision making. Now, one thing I'd like to point out to people, so it's a great point that they bring here about gradually accumulating shares. Well, one might ask, well, what does that mean? Like how much, how many shares? Well, generally, you'll start to see an activist investor begin to accumulate once they start to get to like 3, 4, 5, 6% of outstanding shares. That's when you kind of know that, all right, these guys are looking to make a move. And what they usually do is they'll try to accumulate, and a lot of boards will basically say they'll cut you off at just under 10%. And they'll basically say, okay, you can't. We're not going to allow you to basically buy more than 10% of the outstanding shares of the bank. Why is that? Well, it has to do with voting rights and other things like that. But usually, an activist investor, once they've identified a target and they're going to try to accumulate between 5 and 10% of that stock, and then the next move is going to be they're going to demand a board seat, and they're going to say, hey, we own 8% of this stock, and we demand a board seat now on this bank. Okay. And then they get in on the board. And then the minute they get on the board, they start, demanding changes. Oh, we want a different auditor. We want a different accountant. We want a different legal team in here. We want to talk to some investment bankers. Let's get some things going on here. So, and again, and this doesn't have to be aggressive. It doesn't have to be aggressive. Like I said, they can fly under the radar. This can be kind of a smooth operation for a number of years. But let's continue here, though. So an ounce of prevention is worth a pound of cure. And when it comes to activist shareholders, that means developing a strategy that provides fair value to shareholders. Weinstock says, manage your business as if you could have an activist shareholder someday. He says, if your shares are trading at an attractive price, it makes it a lot more challenging for an activist to come in and say, there's mismanagement here. More boards may benefit from regularly taking a critical look at the strategic plan, Hooper says. If approached by an activist, the board will have to defend that plan and articulate why it's in place. Regularly examining the plan can help ensure the board isn't caught off guard. So Hooper recommends boards acquaint themselves with activist investor groups that tend to operate in the banking space. Because, yeah, there are some standard ones. I mean, there's probably 10 or 15 of them out there that are pretty normal, pretty regular. You know who they are. And it is good to, make yourself familiar with those people and those companies and those individuals. So understand who the activists are, what their goals are, and what their typical tactics are. He said the bank's legal and investor relations team should be able to provide that information. Boards can also consider other defensive measures that may guard against activist shareholders. For example, bylaws could be modified to require longer notice periods for stockholders to put forth proposals, thereby allowing more time to prepare for an activist. Employee stock ownership plans can also provide some defense against activist shareholders, leaving fewer shares available for purchase by hedge funds and private equity firms. It can also be helpful to use holding company capital to buy back stock from shareholders who are looking for liquidity, Weinstock said, rather than leaving those shares available for potential activists to buy up. If confronted by an activist shareholder, the board needs to first understand its responsibility under the law. Those vary by state. For example, companies incorporated in Delaware must adhere to the Revlon rule, which stipulates that when a takeover is inevitable, then the board's duty is to obtain the best price possible for shareholders. In that instance, directors would not consider other stakeholders such as employees or customers. It certainly wouldn't help if you tried to fight it from the get-go. Part of your governance responsibility is to listen to and consider any valid proposal, says Denise Devine, an independent director with $32 billion Fulton Financial Corp in Lancaster, Pennsylvania. An experienced public company director, Devine had her own encounter with shareholder activism when she served on the board of Cubic Corp, a company specializing in defense and public transportation equipment. She said the hedge fund Elliott Investment Management, along with a private equity firm, argued the company was undervalued by the market and sought to take Cubic private. Once you get an activist involved, the board better be prepared to put in a lot of time, Devine says. Directors met 66 times over an 8-month period, she recalls, and the board had to enlist the help of specialized advisors and lawyers. It also obtained an independent valuation for the company. A group of investors, including an Elliott affiliate, bought out the company in 2021 and took it private. In spite of the enormous time and resource commitment, Devine says the activist in that case was never hostile toward the board, which resigned following the buyout. Boards dealing with activist shareholders should resist the impulse to be defensive, Cooper says. Contrary to popular conception, an activist may not necessarily want to upend the strategic direction of the bank. It's best to listen and see if there can be improvements, he says. Yes. Again, I agree with a lot of those comments, but I think it's important to understand that these things, they can be very respective. They can also get very hostile. I think the key is to make sure that your bank is always performing at a very high level, and then you won't run into these situations. But some of the things that they suggest in there about, keeping your bank performing well, buying back your own shares, putting certain things in the bylaws, in other words, don't set yourself up for failure. Make sure all the T's are crossed and the I's are dotted. Make sure that you're doing everything you can to keep things running smoothly. But should the activist investor show up, make sure you have a plan for how to deal with them. And it's not a bad idea to spend a little bit of time researching who these players are, why they operate, why they normally do the things that they do, the things that they look for, and maybe look at some of the prior instances. Like I think Republic First Bank in South Jersey, that I covered. That was like a soap opera. But major board fight, activist investor, once again, Elliott Management involved in that one as well. So again, you begin to see some of the same players when these situations arise. But again, not a bad idea to go do some research on some activist investor stories, some things that have happened in the past, maybe familiarize with some of the situations that arose and why they came to be and what the outcomes ultimately were. But again, thought this was a really interesting topic, given that the pickup in the M&A market. You are definitely bound to see more examples like this out there in the marketplace. Activist investors, obviously, always on the hunt for the next opportunity, right? So, okay, with that being said, I will wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as it always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. Have a great day out there, and I will see everyone again real soon. Thanks a lot.